Downsizer is a real combination of insurance and property and fintech. It's a marketplace where property developers primarily can sell stock to the downsizer segment. The downsizer, or mostly baby boomer segment, who are asset rich, cash poor, looking for their next property, but perhaps don't have the 10% required to exchange. We help them find their next property with zero cash deposit. But what we've learned is that we're fintech, right? We're insurtech. We're all pretty agile. We talked about some good minds in the space already. We move quickly. Whilst we're downsizer, our solution has actually been used now. About 20% of the time has been used for bank of mum and dad transactions.
Hello and welcome to Fintech Chatter, the podcast where I chat with fintech leaders about their secrets to success. I'm Dexter Cousins, your host and the founder of Tier 1 People, the executive search firm dedicated to helping fintech ventures hire outstanding people. With a track record filling mission-critical roles, we're a trusted partner to many of the world's most recognizable fintech brands. Welcome back to our special series on tackling housing affordability. Today's guest is Mark McDuffie of Downsizer. Mark, welcome back.
Thanks, Dexter. I'm really happy to be here.
Mate, so you've been on the show previously. For those listeners who might not have heard it, it was a couple of years back now, and we were talking about the Downsizer solution. So first of all, what I want to say is congratulations. You've made it another 14 years.
That's dog years, is it?
Yeah, it is dog years. Yeah, so congrats. But look, for those who didn't hear that episode, do you want to tell everybody a little bit about Downsizer and the problem that you solve?
Sure. Downsizer is a real combination of insurance and property and fintech. It's a marketplace where property developers primarily can sell stock to the downsizer segment. The downsizer, or mostly baby boomer segment, who are asset rich, cash poor, looking for their next property, but perhaps don't have the 10% required to exchange. We help them find their next property with zero cash deposit.
Cool. So you've kindly joined us to talk about this topic around housing affordability. And I got to be honest, it's, I kind of originally thought I'll do one episode, and I got inundated by people saying, hey, yeah, we'll take part. So first of all, it was like, there's no way I can do one episode. This is a series in itself. But the other thing that's really, I think shocked me, right? And I don't get shocked very often, is the number of high caliber, super intelligent people who are tackling this problem space. I'm across fintech, and I've got to be honest, I've been blown away by the people, not only the level of intellect, but the way in which people are looking to address these problems. But from your side, what do you see as kind of the root cause of housing affordability and accessibility?
Yeah, just before I jump into that, I just wanted to echo your comments. I was blown away by the caliber of people in this prop tech, insurtech conundrum, right? And what I love about that community is we all seem to have each other's back as well, and we kind of know each other's place, and we work really well with a handful of them. And regularly, I'm like the frontier guys that own home, co-posits, all of them. And you say they're all high caliber people, and then there's me, which is great. So I'm not sure I was making a joke, but anyway, housing affordability and housing crisis. I think as my accents, I'm not Aussie, but I feel like I've been here 20 years, and I feel like housing is a national sport. In Australia, it's boom or bust. It's one or the other. The media have got a lot of influence here, and I think that that's one thing that I'd love to see a little bit of an improvement in how they cover it more balanced, right? Because that seems to really sway a lot of the public opinion. But for me, when you ask for one root cause, there is not one root cause. It can't be, in my opinion, traced back to one event, one thing, one policy, one issue.
Yeah.
It's under pressure from every angle: inflation, interest rates, rising construction costs after COVID, forget about it. The feasibility for developers trying to build meant that we're at a record low of building commencements for that, the target of 1.2 million new homes or whatever it is in 5 years. We're woefully short of that. COVID as well. For me, that's always the headline problem. But we at Downsizer kind of see ourselves as a piece of the jigsaw puzzle to help that, because we've got data on 1.9 million homeowners that want to downsize. That downsizer segment controls a huge amount of spare bedrooms every evening. They're in the wrong houses.
1.9 million.
There's 1.9 million
So
homeowners in Australia.
that's like nearly 10% of the population, never mind homeowners, right?
Yeah, regardless of which state you look at as well, about 68% of that national group want to transact in the next 2 years. But they have a block, right? It's either
Yeah.
financial because they don't have the 10% cash to exchange, or more importantly, they don't have the appropriate housing to move into,
Yeah.
right? So it's often referred to as the missing middle, right? We are, we have to get how at both ends of the market. Downsizer is where we operate,
Yeah.
and we think we've got a large contribution to make all the way through and cascading through the housing sector. What do I mean by that? If there's 1.9 million homeowners wanting to downsize, and I would say about 75 to 80% of them have 3 and 4 bedroom houses
Mm.
or units. The sad fact that every night in Australia, there's about 13 million spare bedrooms lying empty,
Wow.
right? And they're mostly controlled by the baby boomer downsizer segment. And yet, on the other side, we're saying we have to build new houses. We have to buy, affordable houses. And our view is, yes, we do need to do some of that. But there's also a huge amount of stock that can be released if we remove the barriers for the downsizer segment and get them
Yeah.
into smaller,
Yeah.
more appropriate houses, free them up for families. The families that are in, townhouses now that want to trade up will release their houses, and there's this cascading
Yeah.
effect.
Yeah.
Yeah, so I think for us, it's operating at one side, but what we've learned is that we're fintech, right? We're insurtech. We're all pretty agile. We talked about some good minds in the space already. We move quickly. Whilst we're downsizer, our solution has actually been used now. About 20% of the time has been used for bank of mum and dad transactions,
Yeah.
right? So the flexibility that fintech has against some of the incumbents is that we can move pretty quickly if we can see an opportunity and a need. And there is
Mm.
so much need out there, we're choking on it.
Yeah. So one of the things that I've found kind of really interesting having these discussions is that, you know, it seems to me that it's whilst it is our kind of without doubt our biggest kind of asset market here in Australia, it seems to be also the most inefficient use of capital I can ever imagine. Kind of lenders mortgage insurance being an example there, but there's so many others. Kind of you've talked about it where you're asset rich and you're cash poor. Yeah, the kind of barriers that are put in place to where if you look at technology now, and I know we've had this discussion before around things like blockchain, where all of a sudden you start to kind of tokenize real world assets, and what does that then mean for how you're able to kind of be able to transact in a far more efficient manner. What's been the approach to I guess your downsizer on actually addressing that problem around being able to really kind of free up that kind of asset and free up the equity within the asset to be able to move? And what are the components you've mentioned? Insurtech, PropTech, FinTech. What are the components you've had to bring together to solve the problem?
Yeah. So, bringing together, I think your call out on LinkedIn was talking about the size of the TAM, right?
Yeah,
If you're starting a new business and you're in fintech, or you've got investors asking you, they're like, how big is the opportunity? This opportunity is enormous.
yeah,
So we've started with the biggest asset class on the planet, residential real estate, unlocking the wealthiest generation in history.
yeah,
That's the downsizer segment. And just to kind of put that into context, whilst I said 1.9 million homeowners in Australia planning on downsizing, we'll talk about some barriers throughout the course of this, but in the UK, our kind of
yeah,
uh, motherland, if you like, we've got data on 7.1 million homeowners
yeah,
that are 55 and above that have got more than 90% equity in their current house. As you say, that's there, it's sat.
yeah,
How do we activate it and unlock it? That's how we set about unlocking that kind of equity, but we don't draw down on it. There's no loan, there's no interest.
Yeah.
We look at Dexter and say, hey, Dexter, you've got a house that's worth $3 million. You've got a mortgage of $250,000. Therefore, your net equity is $2.75 million. If you want to buy using our services, you can buy anything up to the value of $2.75 million because guess what? You're good for it.
Mm.
There's no reverse mortgage, there's no lend. And because it's an insurance instrument, it's a fraction of the cost of capital for lending. So that's the solution. But some of our biggest barriers have been, trust. Who are you guys? You're new.
Yeah.
But the other barriers that we've had is the industry and the incumbents itself.
Yeah.
The industry's like, we need innovation. And the incumbents are like, we need innovation. And you bring them innovation on a plate and then they deliberately try and make it difficult for you.
Yeah. Yeah.
Really?
And is that because, I guess, they kind of, the pricing model, the kind of easy, the easy kind of, I guess, profits from capital and because you hit the nail on the head, right? Like what I look at is I go, okay, if I've got all of this equity, why do I need to take out a loan and pay interest on it to be able to enjoy some of it?
Yeah.
So it kind of, to me, doesn't really kind of make sense, right? That I would do that.
I choose my words carefully because, we still operate in an environment where we're going to be going for an investment round soon. So what we have tried to do, I'm 30 years in financial services tech in 5 countries. You have to partner, you have to collaborate, you have to work with people. But at the same time, if this series of your podcasts is about what can we do, it is we need to collaborate better with the industries and the incumbents. Give you a couple of good examples of what I mean. It's not just the pricing model. It's just like it seems farcical that we had a large global developer funded by a big 4 bank, and they kept rejecting our bond. And it was eventually when we found a friendly buyer that wanted, in fact, insisted on using our process because it was cheaper than anything else in the market. When we got the 2 conveyances together, it was clear that a Word template that had been passed down from development to development to development, the development that had a special condition in it. And when you asked the conveyancer, they're like, that was here before I joined and we've just copied and pasted.
Yeah.
Like, what? So that's unlocked. Having had that conversation, it took 18 months to have that conversation.
Yeah.
And when you get the 2 conveyances, they go, oh, that doesn't need to be there because that was written before solutions existed.
Right. Got you.
Right. So because it was hard coded into a special condition that was copied and pasted for more than 10 years into different developments, that's what the conveyancer negotiates for. So then that's what the funding bank asks for. And without that kind of curiosity, growth mindset, we're never going to be able to break down those barriers quickly.
Yeah.
And 18 months for a startup like mine is a long time to keep the runway going.
Yeah. So in terms of, you've talked about some of the solutions there, in terms of some of the wins, can you talk us through that and, whether that be partnerships, customers that you've helped?
Yeah. So we're now in market, 3 years in market. The first 18 months was kind of soft launch, incrementally MVP, let's call it. Unless you were in 17 suburbs nationally, you wouldn't know about us. And even if you were in those 17 suburbs, you'd have to be 55 and own a house. So now we're kind of scaling nationally. We've had more than $6.5 billion of new developer stock added to our site over the 3 years. So we've got adoption from most of the developers now. In fact, we don't spend any money on B2B business development because we're slowly pointing to the case studies and that's working.
Yeah.
We've sold $168 million of property off the plan to downsizers. So we're making a difference to the industry. Where we've had some specific wins, it comes from the same ingredients. There's got to be an openness and a curiosity on the other side of the table. And what I mean by that is the property developer sees us as a benefit and goes, let's have a try. The agent doesn't see us as a threat because we're selling property and there's always a what about my commission kind of conversation from the agent. And when you break that down and say, look, we're just all trying to sell more, there is, as to your point, and we've said it a few times, it's the biggest asset class in the world. There's enough to make and pay wages, make wages and pay wages there. About 65% of our sales have come in the last 12 months. So we've kind of gone through that.
Yeah.
I mean, talk
Brilliant.
about the valley of death, and we've kind of
Yeah.
come out the other side, and we're still alive, and that's great, and I'm thankful for that. But I am, as you say, 14 years older than we last met. For us, we're now starting to see that adoption of the product set outside of downsizers. About 55% of our buyers are downsizers. Then we've had investors use us, and then we've had this bank of mum and dad transaction, which
Yeah.
is increasing. So let's say Mr. and Mrs. McDuffie, they're in their 60s, they've got a house worth $3 or $4 million, and then their son Mark Jr. is a newly qualified lawyer. He's still got some student debt to pay off, but he's got a good job. This is a true story, by the way, just
Yep.
different name. Mark Jr. buys off the plan. It's 2 years from settlement. He locks in today's price from a leading developer, just under $1 million. His salary will be enough to qualify for a mortgage in 2 years' time, but he can't get approval for that at this stage. So enter mum and dad, who've got a house worth $4 million. They put the collateral up. Mark Jr.'s only job is to settle in 2 years' time when he will have a mortgage.
Yeah.
And if I take that story back to some of the resistance we had from the big four banks at the start, I mean, I used to work for one of the big banks, right? So it's interesting to me that they look at this segment and think we can't sell a loan to them because they're asset rich, cash poor. But they're forgetting the kids.
Yeah. Yeah, it's crazy, right? Like you talked before about, we kind of, when we think of innovation, right? We think like everybody has this image of, going to Stone and Chalk or wherever, and everybody's sitting around on bean bags, and you're drinking kombucha, and you're whiteboarding, and it's not right. It's like talking to the two conveyancers and going, guys, why you keep doing the same thing over and over? Because it's a template, right? Like, I think that's where kind of people get, kind of lost chasing the big, bright, shiny things when, if you're actually following first principles, like that's a great example, right, of first principles thinking.
Okay.
Whereas somebody's going to go off and, raise like $50 million building a solution when actually it was like, oh, we just need to take that out.
Yeah. I'll give you another classic example. I won't name who, but large construction lender, one of the biggest. Again, I've got a pretty good network from my time in financial services, right? And an individual in there had been there 17 years in the same department in construction lending, and there's a risk policy that has a statement on it. And again, there was a statement in there that basically precluded our solution from being used because it predated our solution.
Yeah.
So it must look like this, and if it doesn't, it won't get through.
Yeah.
Okay, so who wrote that and why? We don't know. Predated 17 years ago. Okay, so maybe we should have a look at that.
Yeah.
But
Yeah.
as a young startup, I mean, kind of tying this back to your top of the start, there's a lot of experienced people in fintech trying to hustle and bring a lot of years. I've got, like I said, 30 odd years in 5 countries in large financial services. People, because you see a startup on the other side of the table, they just assume that it's a guy in a bedroom, like a garage,
Yeah.
coming
Yeah.
up with something. It's not. Some of us have got good credentials and we're trying to solve problems in the right way.
Yeah. I think that's kind of interesting you share that, right? Because, if you kind of go back to, a decade ago, I think one of the reasons why you experience what you experience is because, the kind of regulators were just sick of, some dude rocking up saying we're going to, democratize banking and we're going to disrupt it and we're going to Uberize it and do all this other stuff to it. And they didn't have a clue, right? And the industry's evolved so much from there that now, as you've said, right, like you got real serious people, not only with, I think, the kind of, the intellect, the experience, the ideas, the execution, but also, look, the guts to put everything on the line, knowing that, hey, look, this is going to take decades, right? Like it's not going to be like 2 years and we exit and, I'm a billionaire, right? Like you're investing a decade of your life at least to get this thing to the point where you might get some critical mass. And I think this is where, the kind of the frustration lies, right? Is that, the to me, the way that I see it is, the fundamental problems that we can fix right now, the 2 points that you've made: product innovation and credit risk policy innovation, right? Like, they're not fit for purpose, right? Like the kind of way in which we live now, you kind of all of these things that we've got to look at that, kind of have solutions to the problem, rather than, as you said, just build more houses, build more houses, build more houses.
Yeah, I mean, for us, we see it in many different ways, right? But
Yeah.
just building more houses is not the right
Yeah.
way. There has to be a number of different solutions. I'm fortunate enough to see different innovation in different countries because we're prepping to launch into the UK, and
Oh, brilliant.
there's a fantastic young prop tech in the UK called Pathways. You should look at those guys. They are bringing, I think, genuine innovation to home ownership, and it's basically a rent to buy model. You break a
Yeah.
mortgage into
Yeah.
11,000 points, which is 11,000 days, which is the typical length of a mortgage. And if you start paying a couple of days ahead, then you basically own the house as soon as you paid 11,000 days, right? It's a back to back. I love that model, but my point is that, again, there are smart people with good creds coming to this industry to try and help solve problems.
Yeah.
Like for me, it's housing affordability is not a solo sport, which I've heard a few people say before. Fintech, prop tech, insurtech, industry, government need to play as one team if we're going to
Yeah.
help
Yeah. Absolutely.
everybody. And that sounds a
Absolutely.
bit glib, perhaps. I've seen some great things come out of New South Wales government, for example, low to medium density, the pattern book. Great, great. But how does that fit into some of the templates that are still in Word
Yeah.
when you're trying
Yeah.
to get funding and everything else? So it's I think is an exciting time for fintech, prop tech, insurtech to help. I just wish it was a little easier.
Yeah. Yeah. What news have you got to share, Mark?
News. We're I think survival is a good one.
Right. Well, how about I ask you this question, because you touched on this before. Like the next 12 months, you talked there a little bit about looking at the UK. What plans have you got for the next 12 months?
Yeah. Look, we were supposed to. We're planning on launching into the UK market around about this time last year, but we pulled back and focused. Our runway wasn't long enough, so we really focused, doubled down on Australia, got the model working for Downsizer Australia. We've trimmed our burn rate by about 40% and increased our sales by 5 times. So on
Brilliant.
paper, that looks pretty good. We've also finished building our first white label. Deposit Power, who is the issuer of our Downsizer bonds, we actually have replaced their core system. So we spent about 18 months building that for them, first white label. So that every bond that's issued by Deposit Power is now on our infrastructure since the last 6 months. So we'll be shifting into capital raise soon to sell that technology into other use cases. Maybe that's cars and boats and luxury items that take deposits. Uh, but ideally moving into the UK because that opportunity hasn't gone away.
Yeah.
It's much bigger than here, obviously. And I actually think that having spent some time in the UK and the US, I actually think they're more open minded to try new innovation rather than this kind of closed
Yeah.
mindset that seems
Yeah.
to be an industry in some pockets of Australia. It's not everywhere. It's a general statement, but in the UK, there's much more appetite for change.
Yeah. We're coming to a wrap up. As you know, we get great talent listening to this podcast and watching. If people are interested in finding out more about careers at Downsizer, where can they go? And also, if anybody's thinking of downsizing their house, where can they find out more about the solution?
I always invite people to come direct to me on LinkedIn if they want, if that's their preferred mechanism to engage on a one-on-one basis. I will always have a coffee with someone that's interested in learning more about Downsizer as a company or the industry. We regularly take in kind of interns and graduates as well that are curious. If you or your family are considering downsizing or you're investing using zero cash deposit, again, you can reach out to me direct at mark@downsizer.com or hello@downsizer.com. You can also browse a marketplace of at least $2.5 billion of stock that's currently for sale on our marketplace at downsizer.com.
Brilliant. Well, Mark, it's been great to catch up again. Thanks for joining me.
Thanks for the invite, Dexter. All the best.
As always, folks, you can connect with me on LinkedIn, Dexter Cousins. If you're coming back, thanks so much for your support. And if you are new to the show and you're watching on YouTube, make sure you give us a subscribe and leave a comment. And if you're listening on podcast, make sure you follow us wherever you listen to podcasts. Until the next episode, keep well